Hello and good morning, everyone. Thank you for joining this week's ATRAM webinar series. And if this is your first time tuning in, welcome. This is our 12th episode, and we'd like to encourage you to consistently attend as we have more special guests coming in the weeks ahead. Speaking of guests, today we will be talking about multi-asset strategies featuring the ATRAM Philippine Balanced Fund. I am Paolo Delior, Business Development Manager at ATRAM. We like to do things differently at ATRAM. So this week's format will begin with the what, followed by a why, and finally how. As always, we will leave 10 minutes at the end for Q&A, care of our audience. Before we begin, I'd like to remind our viewers that you can submit questions throughout the discussion by clicking on the Q&A button found on your screens. You can choose to ask a question anonymously in the options. We will get to the questions at the end of the discussion. Additionally, I'd like to let you know that this webinar will be recorded and that copies will be disseminated within the day as well as posted on our social media pages. Make sure to keep your eyes on the webinar as we will be wrapping up with a quick feedback survey. We are very fortunate to have one of our portfolio managers to join us this morning. Usually before having access to a PM, you would either have to go through a relationship manager or a third-party liaison. Ante is a chartered financial analyst and has been with ATRAM for quite some time now. To sort of pick his brain, ladies and gentlemen, I'd like to introduce Mr. Ante.
Thank you, Pao, for that kind introduction. It is my first time here talking to our clients in this webinar series. And I'm really excited to share more about multi-asset investing. Specifically for today, we'll focus on the Philippine Balanced Fund, and I think it's very timely to look at diversified approaches in these tumultuous times.
Before we start things off, let me just start off with a question. Are barber shops already open? I noticed that you're sporting a fresh cut.
Actually, it's a bit of a sneaky move. One of my neighbors had a stylist over, and my hair was a bit messy, and my mother couldn't even recognize me anymore. So I said, "Can I use your house as a salon?" And she agreed. So here I am, a bit more ready for the GCQ next week, I guess.
I see. But kidding aside, let me ask the most basic question. What is a balanced fund?
Okay, that's a good question. Let me answer that question by looking first at the objective of this fund. The objective really is to participate in the Philippine growth story by investing in stocks, at the same time managing your risk by investing in bonds. Over the long term, we will invest half of the money in stocks while investing half in bonds. That really enables the fund to strike a balance between risk and return. More importantly, the balanced fund allows investors to immediately benefit from diversification. If you try to mimic this fund on your own, you will need at least $1 million to do so. That kind of diversification. Why? The balanced fund owns, on average, 20 stocks and 10 bonds. If you need 5,000 on average for each stock, you need 100,000. But for bonds, it's higher. One bond, usually the minimum that you can do through a bank is 100,000. If you have 10, then that's 1 million. To get this benefit, you should invest a bit of 1 million to justify your cost. And that's why it's very important and very accessible for everyone to invest in the balanced fund.
I see. So you kept repeating the term diversification. Can you shed light on what diversification is?
I think the best way to explain diversification is to show what happens during bad times. Because one of the biggest benefits is really to minimize the risk of loss and capital preservation. In the bottom right chart of this slide, the red bars represent the drops of the PSEI during bad times. The most recent, as you all know, is the COVID-19 panic, where it dropped 32%. Actually, at the low, it was as low as 48%. But in the same period, the balanced fund was down only 11%. 11% down versus 32% down. The 22% difference between the performance of the PSEI and the balanced fund is very important. Why? Because it enables the portfolio to bounce back faster. If you're down less, you can bounce back faster during good times.
I see. Help a friend out here. See, I want to maximize this opportunity to invest, but I don't have the time to watch the market, research on companies, or even keep up with the different kinds of issuances. Why should I invest in the ATRAM Philippine Balanced Fund?
Well, aside from easily accessible, and the benefits of diversification, like what I said earlier, one of the most important feature actually of the fund is its dynamic nature. What do I mean by that? What's dynamic? As I said earlier, over the long term, we are going to invest half and half in both bonds and equities. But that doesn't mean that we won't adjust or calibrate the portfolio if it's beneficial. What is beneficial? It's beneficial if it can enhance the return or reduce the risk. For fixed income, we can go as low as 35% or as high as 70%. For equities, we can go as high as 65% and low as 30%. We also have the option to stay in cash, especially if we think a panic will negatively impact both asset classes at the same time, which happened in March this year. And that's only on the asset allocation level. Wow. At the same time, on the selection level, we want to own stocks, right? And bonds to gain exposure to those asset classes. But we do not blindly track and buy whatever is in the benchmark. We pick the best strategy to allow us to outperform, both on the asset allocation and selection level. For Philippine equities, we use our own systematic and factor-based approach, where we use quantitative analysis to sift through our investment universe to pick stocks. For the Philippine fixed income side, however, we use the total return approach, where we combine government securities and corporate bonds to achieve reasonable capital gains and reliable income. It works especially in a volatile market like this.
I see. As of speaking, we are undergoing a pandemic like we've never seen before. What are the things that you're looking out for?
You're right, Pao. We are living as history unfolds, and it's a very crucial time for investors. There are three things that we are looking at locally. First is what you have mentioned. Included that's the COVID-19. Obviously, it has a negative impact on the economy, businesses, and consumer preferences. A lot has changed even from 2 months or 3 months ago, and it is still not done. At the same time, this coronavirus is increasing the probability of other black swans to happen. For example, the US-China tensions, and if ever there's going to be a Lehman crisis because of bankruptcy, then that increases the probability of that because there's no revenue for businesses. That's why, as what's the market implication of these black swan events? We think the fund needs to be nimble and to hold tactical cash if it can, as we can take advantage of any opportunities if they arise, because there's a lot of volatility. Volatility is scary, but it's also an opportunity to take advantage of. The second really is the unprecedented response by the government. The BSP, as you all know, has cut its interest rates aggressively and guided that it will ease more. Congress is now preparing also several measures to help the economy recover. And one of that is the cut in corporate income tax. Therefore, after all of these factors, we think that we are further away from the disaster scenario. Also, because of this, we believe that interest rates will stay lower for longer. And for equities, we're anticipating the pickup in economic activity will boost sentiment. Therefore, what did we do? We added weight in equities and took profits in fixed income or bonds when yields rally. The third theme is a combination of the first and the second, and that's macroeconomic uncertainty. As I said earlier, we are far from certainty. And therefore, we will need to be disciplined and stick to our process. We will need to be diversified because we do not know which asset class will really outperform over the other. And at the same time, we need to be on our toes as we remain situation dependent and opportunity driven.
I see. So given what you mentioned, how does this translate to the positioning of the fund?
Okay, that's a good question. Because of all of these themes, as of end April, we are invested 45% of the fund's capital in stocks, 40% in bonds, and the rest is in cash. As I said earlier, we want to be nimble and choose our levels wisely. Actually, if you asked me this question a month ago, it's going to be completely different. Our positioning then was 30% equities, we are underweight, and 70% in fixed income. And that really helped the fund this year. If you notice, fixed income now is in positive territory, while PSEI is still down. So given that allocation, and as we took profits, the funds benefited from our asset allocation. But right now, the relative attractiveness, because you have to compare equities and fixed income if they're attractive or not besides each other, is we think that the equities now has a more upside moving forward. But at the same time, in fixed income, if yields go up again, and as the BTR issues more treasuries with longer dated debt, then we might be able to get some of those bonds and increase the duration of our fund.
I see. So I heard a lot about taking profit.
Yeah.
I guess
Yeah.
the more pressing question is, how about the performance of the fund? How's the fund doing?
The fund is really doing well this year as we use the new approach. If you look at the performance, the light blue line is the PSEI level or return as of end April 2020, and that's 27% down. If you look at the indigo one, the line, that's the benchmark for the balanced fund, and that's 50% PSEI and 50% bonds, and that's 11.5% down. If you just look at this performance, you can just see again the diversification benefits of having both equities and fixed income in your portfolio. You want steadier returns and steadier risks. But the more important part here is that Philippine Balance Fund is only down about 10%, right? 9.99%. And that means we outperformed our benchmark by 1.5% or 150 basis points. And I think that's coming mostly from our overweight fixed income position and overweight fixed income duration. We were holding longer dated bonds, and that worked well for us this year. And moving forward, we hope to continue that dynamic approach. If there are opportunities, we will do so. And I guess that's a good way to look at the balanced fund. If, for example, right now we're a bit neutral, we're 45% in equities, and if all of those positive factors that I've given, monetary stimulus and fiscal stimulus will happen, and there are many drug developments that are positive, then it's likely currently at least that we have a higher risk return profile for equities, Philippine equities.
Thanks, Yvonne. You've covered a lot of ground, and this might be difficult to remember. So, in a nutshell, how would you synthesize what we've talked about? And please feel free to use an example if you think that it would make us understand better.
Okay, so I would compare it to Waze. For those who do not know, Waze is like Google Maps, right? Where you open the app and then you type in the destination and then set the priority to either time or distance. Then you can refine the routes by saying, oh, I don't want to pay toll, or I want to avoid major intersections, or I want to use side streets, etc. After that, we can pick the route that we want, and just like that, we are on our way to our destination. In essence, that's how we started the multi-asset process or the balanced process. The first question we ask our clients is, where do you want to go? What is your destination? Is it income? Is it capital appreciation? Is it saving for retirement? Or is it to provide for your family? For the balanced fund, obviously it's both capital appreciation through stocks and income through bonds. Then the second question is, what is your preferred way to get to your destination? Would you like higher returns, but obviously higher risk? Or would you like steadier returns with steadier risks? For the balanced fund, it is the latter. We can go to our expected destination, a diversified approach with steadier returns and managed risks, and we preserve our capital better. Having combined all of those factors, we now have the available options and routes to go to our destination. Those are the routes that the multi-asset approach provides, and we believe that the balanced fund is one of those best routes out there to get to your destination of steadier returns and steadier risk, a diversified approach. And I think lastly, what I want to for our clients to think about is, people usually think that the Philippine Balance Fund is a 2-in-1 portfolio, right? It's equities and fixed income. But for me, and personally, I think of it as a 3-in-1. We have fixed income, we have equities, and we have cash. Sometimes people forget cash, but in situations where there are panic, cash is king, and therefore it's part of our process to have cash sometimes. Thank you for having me, Pao, and I hope you have learned quite a lot. It has been a pleasure sharing with you and our clients.
Thanks, Ivan. I hope that from this time on, every time you open Waze, you remember ATRAM and the ATRAM Philippine Balanced Fund. And finally, I've been coming across the comment section on our social media pages. And the top question that I see is how to invest. Luckily, we will be joined by our Client Services Officer, Ms. Cherubim de Guzman, to share with us the easiest and most convenient ways to subscribe and begin participating in the fund.
Thank you, Pao. Good morning, everyone. To open an account with ATRAM, first, you just actually need to visit our website, www.atram.com.ph, if you need to learn more about the funds. Second, if you have more questions about the funds, visit our site's FAQs or ATRAM Academy's page. Lastly, it will then guide you to our online investment platform, Seedbox. By the way, Pao, a minimum of just 1,000 pesos is needed to invest in the ATRAM's peso-denominated mutual funds. Thank you.
Thanks for that, Cherubim. At this point, let's look at the questions from the viewers, shall we?
Okay, sure.
I see a question here. What is the current cash level of the fund?
As of end April, as I showed in the slide, it was 17%. But really, like what I said, we kept on adding to our equities position as we think that the risk reward is better for the equities position versus the fixed income. So right now, as of yesterday, we are about 10 to 50, about 10% cash level. So we invested 7% of our cash level as of end April to equities.
I see. If the US goes to negative rate, how will the peso and our interest rate affect us?
So if that happens, and likely based from the pronouncements by the Federal Reserve governors, they won't let that happen because that's negative for banks, right? But if it does happen, then it will impact interest rates in the Philippines also. So if, for example, this is the US interest rates, currently we're here. This is the US and we're here. Obviously, we have higher yields. If it goes further down, then people would look for more positive yields in the world, right? Because if you invest in a negative yielding debt, then you are paying the creditor, the debtor. You're paying to give your money to someone else, and you don't want to do that. So people are gonna look for yield, and if our macroeconomic story is still good, then it's a very attractive to have 3%, 2% yield versus a negative interest rate.
Okay, so I have a very interesting question here. What is the ideal mix of balanced fund? Given two scenarios. First, when the market is down. Second, when the market is recovering or has recovered. What are the triggers for fund holder to switch?
Like what I said, usually in the balanced fund, we do that for you. We look at the markets for both equities and fixed income. We also look at the factors globally because that impacts local markets. For equities, it's 50% of investors are foreign. So whatever happens globally, it can affect locally. So having said that, for the first scenario, what's the balanced approach? What's the allocation? So when the market's going down, usually if it's still starting, if the equities market's going down, obviously you would want to have less equity. But at the same time, you have to look at each stock to see the quality or the value of each stock. You can't just say, I'm going to sell every stock there is, for example, for COVID, because there might be stocks that are beneficiaries of COVID and some are not. So you have to be really, you go to a deep dive on each sector and each stock. So it's not as simple as, I want to sell equities all over, but we have to choose our battles. And because when the market's going down, you can find a lot of value also, right? It doesn't mean that it's going to go down forever. Because if you think, in our view, is if the disaster scenario has been averted and stimulus from both the BSP and the central government will continue, then at least we are back on the road to recovery. And businesses will benefit from that. And therefore, if businesses benefit from that, then stocks will continue to recover. So at the same time, your second scenario, if the equities market is going up, if you think it depends on the valuation and the relative attractiveness between fixed income and equities, that's the first. That's the first thing to look at. You have to look at the how do I think about it? If you have to look at the if equity is attractive, if it's going to give you the best risk reward or fixed income, you have to look at them together at the same time and see who is more poggy or who is mas maganda, who can give me the best risk return. And if, for example, even though the equity market is going up and you still have better risk reward proposition for equities, then we will have to add to our equities position. It doesn't necessarily mean that we were gonna reduce if it's going up, right? Or as long as we know the value of the equities is as long as within our expectations, then it really depends. So basically, in summary, it depends on the attractiveness of each asset class. You can be both. For example, the easiest example is in March. For the balanced fund, we were 30% equities and 70% fixed income. And that helped us a lot because we thought that it's still not priced in, that there will be panic. Foreigners are going to sell because they need liquidity. And there's not much people to buy in the local market. So that view was correct. We were 30%. We didn't look, and then we didn't really go down with the PSEI, but only 30%. But that enabled us to really to put our money back. When the fixed income rallied, we took profits and put it back in equity. So we got both capital preservation and we took advantage of lower equity prices.
I have a question for
yes, sure, Phil. Sure.
And could you maybe share with us your top 3 equity holdings now? What are the top, yeah, to use your own words, the most poggy stocks that you have in your portfolio today?
So the top 3, the stocks that we are holding are really the quality stocks, the conglomerates that we have. First is SM, and we all know how big SM is and how resilient it is. It has everything. Probably it has banking sector, which is very steady. It has property. It has malls, and it has a retail. So if, for example, our view is correct that there is economic recovery, then SM will be the best proxy for that, and it's very liquid also, and foreigners like it. So there are a lot of factors going for SM, and that's why it's one of our biggest holdings. The second one is SM Prime. SM Prime is obviously a subsidiary of SM, but we think that there might be a lot of opportunities there because, as I said, the property market has been relatively weak because you don't have any construction. People are not outside to look for condos. People are not in malls. But what we think is that on a relative basis and long term, as we move from an MECQ to GCQ, then I think it's a bit of priced in. So we will need to take advantage of that as it improves. And the next one is Ayala Corporation, and it's the same story as SM. Ayala Corporation is really into banking, property, and also a lot of industrial, and that's a proxy for the Philippine economy. At the same time, they are very good in terms of ESG. The governance is top notch, and they're very socially aware. Given that and the valuation of AC and its subsidiaries, then we like AC as a stock moving forward. So we have SM, we have SM Prime, and then AC as of end April 2020.
Thanks, Ivan. I also just noticed on one of the slides you showed about the range that you can invest in. I think your minimum, can you clarify the minimum for fixed income again?
The minimum for fixed income is 35%.
Oh, 35%.
So 35% and the maximum is 70%. So like what I said earlier, in March, we were at our maximum 70%, and we were at our minimum equities 30%. And obviously, if for example we have a very high conviction call, we want to go obviously lesser equities in that kind of scenario. But at the same time, sometimes investments do not go your way. So what we do is really we manage the risks of us being wrong. So even though we are very negative equities, and at that point in time, we still held 30% for just in case we were wrong. At the same time, we want to stay diversified. So we are disciplined in
I
this
guess the
process.
point here is that
Yeah,
to be a bit active in terms of the asset classes that we choose,
yeah,
to overweight or add more investments or assets towards them.
yeah.
Okay, thank you, Van.
Mhm.
Thanks,
Yes,
Ivan.
Mel.
I just want to circle back a bit since I think your talk
Okay.
has been working. I received the question, what is the management fee? What is the minimum holding period? What if you want to liquidate before term? Chet, can I ask your help to answer this
Okay.
question?
Sure, no worries. There is a minimum holding period of 90 days, and there is an early redemption charge of 1.12%. That's with EVAT. And for the management fee, that's 1.75% per annum.
I see. Thank you very much for clarifying that.
Thank you.
Ivan, do you still have anything else to share?
Well, I hope you guys invest in balance fund. And if this is not the approach for you, then we have a lot of other funds. And please stay tuned for more webinar series. And I hope I can see you again and share with you multi-asset investing further. And if you have any questions, let us know also. Then we will do our best to answer those offline. Thank you, and I hope you have your haircut soon, because I think everyone's just gonna be going out again.
Thanks.
Thank you, Bob.
Thanks. I think we can leave it there for this webinar. Thank you, Ivan, Che, and to our audience as well for your questions. If you have any further questions or would like to learn more about ATRAM's funds, strategies, please get in touch with your relevant ATRAM relationship manager or visit our website, atram.com.ph. Lastly, please answer the survey at the end of our session, as your feedback is most valuable to us. We appreciate you taking the time to join with us. And on behalf of ATRAM, I would like to wish for the safety of you and your family. Best of luck. Thank you very much and have a great afternoon.
Thank you.